Hello, everyone, and welcome to Crisil Ratings podcast on the outlook for the emerging corporates in the diversified construction sector. Crisil Ratings covers approximately 200 emerging diversified construction companies with estimated aggregate revenues of Rs 1 lakh crore last fiscal, which is about a tenth of India's total infrastructure spends. These are companies with revenue profiles of Rs 200 to 2000 crore for fiscal 25, with presence mainly in sectors such as roads, civil construction and urban infrastructure, railways, and water. The sector will continue to see steady growth this fiscal, with revenues growing 9 to 11% compared with close to 15% growth in the past 5 fiscals through 25. Healthy order books, driven by timely execution of projects supporting their credentials, have resulted in the continued scale-up of operations. Revenue visibility for the segment remains adequate, with the order book at around 2 times the fiscal 25 revenues. Moreover, the order book remains fairly diversified. It is pertinent to note that within the road segment, these companies have increased exposure to both engineering, procurement, and construction and hybrid annuity model projects over the past 2 fiscals. Also, increased spending in railways, buildings, and other government funded infrastructure projects has helped further diversify order books, thereby partially insulating the segment from a slowdown in the roads as reflected in lower awarding of contracts in fiscal 24 and 25. However, profitability will remain flat on year as competition within the segment intensifies and subcontracting charges remain in check. To be sure, aggressive bidding and increased competition have already kept profitability range bound for these companies over the past 2 fiscals. Adding to it, limited ability to pass on the impact of sharp commodity price fluctuations and stronger competition will limit the operating margins to 10 to 11%. While the working capital requirements of emerging construction companies will be higher on year, it will be funded mainly by better cash flows and risk management practices, thus limiting fund-based working capital bank borrowings. Improving risk management practices should support profitability and cash flows going ahead. While half of the current road order book is from central counterparties, civil construction and urban infrastructure projects are split equally among state and private counterparties, with lower share of central projects. This is driven by healthy state spending in buildings and other urban infrastructure development projects that are mostly pre-funded. This balanced project mix will ensure a steady working capital cycle even as dependence on creditors reduces. But timely funding availability, both fund and non-fund based, along with incremental deposit requirements, remain critical for continued growth. Timely execution of sizable order books will also entail debt-funded capex for equipment purchases. Given the dependence on a mix of leased and owned equipment, long-term funding requirements this fiscal is seen at Rs 2,000 to 3,000 crore, which will be funded by 80 to 90% debt. Nevertheless, strong cash flows will ensure leverage levels are under control, thereby supporting the credit profiles of these companies. Overall credit metrics are expected to remain stable, backed by strong balance sheets of emerging corporates. That said, any slowdown in project awarding, order book buildup, or cash flow uncertainties related to regional challenges will bear watching. With this, we come to an end of the podcast. Thank you for listening.